Morning. I hope you're all well. It's been an incredibly brutal month. Wow. April was tough. The good news is that I actually do, for a change, have some good news on the market front, and I will be getting to that later. I've also, at the end of the presentation today, got a great slide that summarizes all our thematic funds and the different wrappers that they are available in and the different fee classes. I also want to thank all of you who've sent through questions throughout the month. I'll do my best to answer them as I go through the presentation. I do try to build them into the slides, but if I do manage to forget something that you've asked for, please stick it up on the chat, not the chat, on the Q&A, and I will get to it after the presentation. So thank you very much for joining. Let's get into it. As I said, April was tough. Risk off intensified, inflation concerns led bond yields to new highs, markets sold off, and things were tough across the board. As you can see in the top here, the red bars, which look at the standard core funds or the usual global and South African equity indices. World equities are down 2% in rands, South African equities down 4% in rands, US equities as well. In fact, the only bright spot was UK, the FTSE 100, UK equities positive in rand terms. And we have said that we prefer value while interest rates go up and while bond yields are rising, and value certainly has protected itself more than other asset classes. Moving into our thematic satellites, you can see the top one there is value, also positive for the month in rands. Emerging markets in China surprisingly doing nicely. They're starting to consolidate, a lot of positive catalysts coming through from EM and China. So after some tough couple of months, very happy to see there's some consolidation and hopefully a turning point coming in those markets. And I'll certainly talk more about that. Healthcare as well, looking nice and defensive as it's supposed to be, 3.3% in rand, so very, very, very happy with that. And then no surprise, the two worst performers in the month, the tech stocks. Fourth industrial revolution, protecting capital, well, not protecting capital, but relatively doing better than FANG, as the small cap exposure and the more diversified exposure led to the fund falling 7% in rand terms. FANG had a very tough month, down 14%, certainly something that we have been expecting. The valuations there are looking quite stretched. And although those businesses are phenomenally great businesses, when interest rates are rising, when growth as a style is under pressure, and when valuations are stretched, we do expect a lot of volatility. So yeah, that was a tough month, down nearly 14% in rands. Gold and global bonds negative in dollars for the month. Only the rand was offered any protection, and the rand there being the best performer of the month, rand dollar up 8%. And we continue to believe that your best defense against risk off and volatile markets is hard currency cash, because bonds and gold are so distorted by quantitative easing and all the other asset classes that then get impacted by very low interest rates. And I'll talk a bit about that when I get to the US slide. But it's yeah, it's been a tough month, and hopefully things aren't as tough going forward. But before I get to the good news, let's have a look at how that impacted some of the Sygnia funds. So looking at the top Sygnia funds for the month of April, on a 1 month basis, it was all basically the 100% global funds. So Skeleton Global Cash, which we did send out a note this month. I hope you all received it. That's a great fund if you're looking to top up your global exposure in your retirement annuity or your living annuity. If you've got maximum equity already in your retirement annuity, but you want more offshore, then the safest way of doing that is just to increase your offshore cash, your dollar cash, and the Skeleton Global Cash Fund is perfect for that, for retirement annuities, living annuities, and endowments. And it's on the platform. So that had a great month because of the rand weakness. It was up 7.3%. All of these funds being global only funds. Global Property was the fourth fund, and as I also mentioned, Regulation 28 does allow up to 25% in property, so you can go maximum equity and put money into property if you want to go up to your 45% global, and you already are capped in terms of the amount of equity you can take offshore. And then, as I mentioned, number 3 there, the UK doing very nicely, as it is very much a value-styled index at the moment, and also has quite a big allocation to oil, and oil doing very nicely, and is expected to continue to do nicely for a while. So, although the UK has underperformed for some time, it looks like it's finally having its day in the sun, as most value indices eventually do. Just takes a while. Then on a 1 month, sorry, on a 1 year basis, value still doing very nicely. The Divi fund up 36%. So the Divi fund's done very, very nicely, and that's predominantly because it looks at stocks in the South African stock exchange that have high dividend yields. At the moment, that tends to be resources, so it is doing very nicely as resources continue to do well. Resources, I will talk a bit more about later, but it's expected that commodity prices will remain elevated for a number of reasons. So, this commodity cycle may be longer than usual, which would be good for the Divi Index Fund. Second is the Sygnia Life Berkshire Hathaway Fund. Again, value, this is now global value, continuing to do very nicely. Health Innovation is the 3rd best performing fund. As I said earlier, very defensive in terms of a style, and a great overall portfolio. Global Property is 4th. And then surprisingly, South Africa Top 40 Fund number 5. So SA, which has been struggling for some time relative to emerging markets and relative to global developed markets, is having its day in the sun thanks to resources, which have really done well over the last year, and have pushed the Top 40 Index Fund into the number 5 position over 12 months. So still some decent returns over a 1 year period, and as long as you're well balanced in terms of different asset classes, local, global, your portfolios are relatively well protected during these downturns, especially with the weaker rand. So I did mention some good news. It's more of a silver lining than good news, and I'm certainly not calling the bottom in the route that we're going through. I do think volatility is here to stay for the next 6 to 12 months. Or actually, volatility is going to stay with us for the next decade at least, while we remain so heavily indebted globally amongst consumers, governments, corporates, all with very, very, very high gearing levels. Means that volatility is going to be here to stay, and something that we certainly use rather than being scared of when it comes to our asset allocation process. But looking at the AAI weekly survey, which is the bull minus bear index, which is a way of looking at investor sentiment. You can see here the red square, 2022. The index is the 3rd lowest it's been over the last 30 years, and it's certainly the lowest it's been since 2009, which is quite incredible. Markets certainly aren't nearly as low as they were, or sold off as they were in 2009, but there's a lot of angst out there. There's a lot of concern, and investors are the most bearish they've been since 2009, and that certainly does mean that any froth that was in the market, or any excess valuations has come off. Markets are definitely looking a lot more reasonable than they were in January, and certainly a good base in terms of expecting decent returns over the next 6 to 12 months. So we were underweight equities early on this year, and we have since closed that underweight and taken profits on that protection. We're now neutral, and are looking for better entry points to actually go long risk at this point and go overweight equities. As I said before, this is not necessarily calling the bottom, but when sentiment is so negative, when everyone is driven by fear, well, that is certainly a better entry point than when everyone is driven by greed. And so we'll be watching this along with a number of other indicators that we look at to see when it's time to actually go overweight. But we're feeling a lot more bullish on market valuations, even if the economic news hasn't settled just yet. So, one of the biggest causes for concern about a recession over the next 6 months is the US. And US interest rates pushing the US into a recession. Inflation is out of control. It really is. 8.5% year on year in the US. The Fed is way behind the curve. If you look at what the market's pricing in, the Fed is behind the curve. The Fed meets tonight. They're likely to put through a 50 basis point, 0.5% increase in interest rates, which is a massive increase, which means that they are finally admitting they are behind the curve. Yes, it was impossible to forecast COVID. It was even more impossible to forecast Russia invading the Ukraine to the extent that they did, the way that they did, and the impact that would have on inflation from a supply disruption perspective. So we've got inflation right now is being driven not by demand, but by supply disruptions, and that's led to massive inflation around the world, particularly in the US, which has been hardest hit because they were so generous to during the COVID periods, and still have a lot of people who would rather just not work than earn a low wage. So the Fed has to act, and more importantly, they have to try and protect their integrity and their credibility, and so they will act tonight. But the good news again is that markets are pricing most of this in. So markets are already pricing in 270 basis points, 2.7% interest rate increases over the next 2 years. The yield curve is flat. The US yield curve on a 2 to 10 year basis, it's both roughly about 3%. So the markets are pricing in a lot of the inflation risks, and bond markets are pricing a lot of the interest rate hikes. So that is the good news, is that the market is pricing in a lot of the risk. The bad news is that they are certainly going to be a drag to a number of factors. Interest rates going up is going to make housing affordability an issue. QE is unbelievable. It's likely to start at 95 billion rand a month. It's over $1 trillion of bonds that are going to be sold over the next year. It's more than double the rate that was sold in 2017 to 2019. So there's going to be a lot of disruption in the US, and I think it needs it. And we've spoken about us being underweight, or Sygnia being underweight to US for quite some time now, and that is finally paying off as the US comes off. But I've always talked about the cause why we are underweight the US, and it's valuations, it's quantitative easing, it's basically free money interest rates, the fact that the dollar is too strong, that there are risks when it comes to the tech regulations. So there are a number of sort of causes, but what I actually want to today just focus on the effect. And to me, the simplest effect, and what I'm using as just the back of the matchbox, is Tesla's market cap. So the fourth biggest company in the US is Tesla. If you've been long Tesla for the last couple of years, and you didn't sell after that first 100% return, and then the next 100% return, you've done very, very well. It is now the fourth biggest company in the US. The only companies that are bigger than Tesla are Microsoft and Amazon. It's quite incredible. Only Microsoft and Amazon, who have hundreds of millions of users, that are global companies, are bigger. And if you look at the chart on the right, it shows Tesla's market cap versus the market cap of every other car manufacturer in the world. This is put together by Wall Street Bets. You can see here Toyota's got the biggest market cap at the bottom right, 230 billion, then Volkswagen, then General Motors, then Mercedes, Ford, BMW, and you put them all together, they've got roughly the same market cap as Tesla. So, okay. But you look at the revenue, those companies combined generate 30 times the revenue of Tesla. 30 times. Yes, the growth forecasts of Tesla are better, and EVs are certainly the future. But most of those companies, on the traditional companies, have great EV programs. Mercedes have just got launched an EV that has a 1,000-kilometer range, which is certainly going to challenge Tesla. So I think this is a nice, I don't want to call it a canary, but it's just, it's a great effect of what quantitative easing has done. It's a great effect of what cheap money has done in the US. It's a great effect of what low interest rates have done in the US, of what possibly just following earnings revisions and ESG craze has done. And I think until we see some, well, from my perspective at least, until we see Tesla start to not be valued at 30 times all the other companies put together, I think the US is still frothy. And I think the US has to come off of it. And we have seen some big dips, and we saw Netflix that's lost more than half its market cap when its subscriber numbers were down. We saw Facebook a while ago, it lost 40% of its market cap on bad news. Amazon's just put out bad subscriber data. So as we come out of this period of COVID when everyone was forced to be online and move into more traditional world, yes, there's going to be some move away from online spend, and a lot of that froth is certainly coming out of these stocks. To the point where they're not looking nearly as expensive as they were. But Tesla is definitely the one that hasn't come off it at all, despite Elon Musk selling $9 billion worth of stock to buy Twitter. And yeah, so we are watching that quite closely. But back to the US and inflation. So another good data point, and it's certainly not doesn't mean it's the end of inflation, but core inflation decelerated sharply month on month. So when we had this March number of 8.5%, the highest year-on-year inflation since 1981, core inflation is actually at a 6-month low. So we are starting to see some of the COVID impacts roll over. And yes, while we still got a lot of supply disruptions on the way from Russia and energy prices in particular and food prices, at the same time, inflation was already elevated because of COVID. And so we're in a bit of a volatile period as we move out of COVID disruptions into the war disruptions from a supply impacting inflation, but we are coming off highs. And inflation is very much a base effect. So we're coming off a very high base effect. And already the core numbers are starting to look low. So when you've got core numbers rolling over, and you've got bond markets already pricing in 3% of hikes over the next 2 years, I think a lot of the bad news is priced in, and that's what we're seeing certainly on from an investor sentiment perspective on the equity market. That a lot of the bad news is already priced in, and growth hasn't gone away. Yes, growth is going to be lower as a result of high energy prices and more uncertainty. But we're not forecasting recession in the next 6 to 12 months. So it's become tougher, and the market's just priced in the risks that have happened. And as the COVID uncertainty unwinds, particularly in China, and the inflation starts to roll over in the next 3 to 6, probably 3 months, we are expecting a better second half of 2022 and some recovery in markets. That said, I'm still concerned about the US, just from a valuation perspective. And so we do prefer being overweight value in the US, which then removes Tesla. Tesla, just out of curiosity, is out of interest, has just fallen out of or been removed from our S&P 1200 ESG index. So it's fallen out from an ESG perspective, even though it is an EV car maker. So we are starting to see some headwinds there, being removed from some indices. Elon selling $9 billion worth of stocks. So we may see some normalization in that share price. And again, not that it's a bad company, it's just the 30 times every other company put together is a bit confusing. So we remain underweight US. We also expect the dollar to weaken. So traditionally, in a rate hiking cycle, the first 6 to 12 months of US rate hikes, the dollar normally weakens. And emerging markets do very well. Of course, because of the war, we've had risk off, and the dollar's been strengthening over the last month, and that's been very much because of a flight to safety. But again, as that unwinds, we should start to see more traditional numbers coming through, because you only raise interest rates when growth is good, because growth drives inflation. So it's quite odd to have this massive uncertainty and risk off at the same time while interest rates are going up. But it is, as I said, a supply-driven disruption. So bottom line, remain underweight US, but still overweight, well, neutral equities as a whole, but expecting things to recover nicely over the next 6 to 12 months. China. Now, I've been bullish on China for a couple of months, and I've been wrong. It's certainly taken a lot longer to stabilize, but China really has moved. Last month, I talked about whatever it takes, and I was using the Mario Draghi analogy from what he had to do when it came to saving the euro during Brexit. And we've actually now moved to that point in China where President Xi has come out with his own whatever it takes. He's calling it an all-out effort, but they've actually finally put a little catchphrase to it. So China's now moved into the all-out effort function. And here we've got Yang Weimin, who's a member of the China Politburo, and he's saying we should adopt targeted measures that can generate quick results and step up policies for support for growth. So he's not alone, as I mentioned. President Xi talked about all-out effort to increase infrastructure, construction, and boost GDP. And then we had Premier Li, which is very positive for NASPAS, saying that they're pledging, the China State Council is pledging to promote the growth of internet platform companies. So as you know, over the last 12 months, we've had a lot of headwinds to NASPAS as a result of Tencent, with a crackdown by China's State Council on internet companies and trying to rein them in and control them. That's now completely reversed. They're now saying the healthy development of the platform economy should be facilitated to drive the creation of more jobs. So that's turned on its head. And it was followed through with China approving its first batch of gaming licenses since July last year, which again is very positive news for Tencent and very positive news for NASPAS as a result. So we're certainly seeing a number of catalysts that are driving the stabilization that we're seeing in China share prices, and as a result, emerging market share prices. And we've still got China supporting policy with interest rate cuts. So whereas the rest of the world is driving interest rates higher, which obviously makes your debt payments higher, which is bad for earnings, which is bad for equities across the world. China's busy cutting interest rates, which is great for earnings and great for profits. So it's another reason to be anti-cyclical, be in China and be behind the government that's actually really trying to support their markets. So China cut its reserve rate requirement by another 25 basis points, unlocking 530 billion yen of long-term funding. It also cut its FX required reserve rates ratio by a full percent. And this is following on a lot of effort that's happened over the last 3 months, and that's finally following through into their total social financing, which the chart on the right shows very nice bounce and a solid bounce that's coming through in terms of their spending and their credit impulse. So it's all looking pretty good for China. Yes, one of the reasons why China has taken so long to bounce in terms of the equity market is because of the COVID wave that has ripped through China. And with their zero tolerance policy, we've had 50 million people in lockdown, and there's been a lot of concern about growth, and that's understandable. But COVID is something that passes. We all know it's waves. We all know that Omicron is the weakest wave that actually is less lethal than normal traditional influenza, and already that COVID wave is rolling over quite dramatically in China, which will allow opening up of the economy, and again we should see some growth recovery. So that's been one of the plays that's happened quite aggressively over the last 2 years. Markets sell off whatever countries currently in lockdown, and buy the countries that are opening up mobility. It actually, if you try and track it as in terms of driving performance, it's a lagging indicator, not a leading indicator. So you don't want to follow that. So that's why we think it's another good reason to be staying overweight emerging markets, staying overweight China as it rolls out of this hectic COVID wave, which markets are pricing in the low growth, but it will bounce back with all the support that's happening at a policy level. And then we have Russia. I've actually put Russia last this month, and not because of any other reason, but the fact that it's pretty much behaving as expected. We're now 10 weeks into the war, and after Russia regrouped in the east, they've only made marginal gains, and there really hasn't been much change. So things are kind of moving along in terms of the game plan. Energy prices are remaining high. Europe is looking at moving away from Russia as a source of gas and oil. Russia is doing a lot of saber rattling here. We've got Russian Foreign Minister Sergei Lavrov saying the risk of a World War III is serious. And I'm sure Russia think that, but it's just part of them trying to take themselves seriously. And when it comes down to what's happening, we're down that road already. We've got Germany talking about moving away from oil. Germany's already moving away from gas. And we did have a spike in gas prices this month. There was some concern when Gazprom cut off natural gas exports to Poland and Bulgaria because they weren't prepared to pay in rubles. But this isn't as hectic as it sounds. Poland has already secured US LNG shipments, and their Baltic pipeline, which will transport natural gas from Norway to Poland, is expected to be completed in Q4 this year. In addition, a number of the big gas distributors in Germany, Austria, Hungary, and Slovakia are preparing to open ruble accounts at Gazprom Bank in Switzerland. So the gas disruptions aren't going to be as bad as expected, and everyone's already making quite strong concerted efforts to move away from Russian oil and gas. So the bottom line is oil prices are going to stay higher for longer, and gas prices are going to stay higher for longer, and that's going to keep commodity prices elevated. Because one of the things that commodities are energy intensive. Mining is an energy intensive industry, and as a result of high energy prices, high input prices, it'll keep other commodity prices elevated. So that brings us to the chart on the right, which shows JSE Resources 12-month forward PE ratio. And you can do a very simple back test. If you have this chart, you look at PEs, and you have the underlying price index, and you have perfect foresight. And so whenever resources were cheap, you buy resources, and whenever they're expensive, you sell them. What happens? You have the worst performance you could ever have. You have absolutely terrible performance. The worst time you can ever buy resources is when they're cheap, because resources are cyclical, and they're cheap at the top of the cycle. And at the top of the cycle is when the resource prices start to come off, but expenses are still rising, and we're seeing now in terms of locally, in terms of wage strikes, because there's huge profits and everyone wants to share in those profits, and those costs go up and they squeeze the margins. However, I'm hesitant to say this time is different, but it does look like we've got some strong foresight over the next 2 years at least, that it's going to take for countries to find energy security. And it's all about energy security. That's the new ESG. Everyone wants security. Everyone wants to make sure they've got food security, energy security. They're going to move away from Russia, and that's going to keep commodity prices higher, and in particular energy prices, but it has a spill-on effect to all commodity prices. So that while commodities might come off, they probably aren't going to come off as quickly or as fast as they have in the past, which means that this chart, which is normally a fantastic sell signal, is probably not a fantastic sell signal right now. And it's likely that those companies, despite being so cheap, will continue to generate good cash flows, and the dividend yields will stay high. And even if there's a lot of volatility, which we'd expect, there should be decent cash flows coming out of those businesses. So that's the one impact, which is good for South Africa. The other impact is that Russia's dollar asset freeze, that I've spoken about before, has China in particular very concerned. They are looking to diversify their foreign currency reserves. They don't want to put it into dollar assets or Western assets, including Japan, because they don't want those assets frozen for any particular reason if they do something the rest of the Western world doesn't agree with. So they are probably going to look to abstain regions. So we had that vote. The Human Rights Council voted to remove Russia, and there are a number of countries, particularly emerging markets, and then who voted to abstain. South Africa is one of them, and the upside to countries like South Africa who abstained, and I'm not saying it was the right thing to do to abstain, but the upside is that we are likely to get support from China and other countries like that who are looking to diversify their FX reserves. So some of the impacts of longer term impacts of the Russian invasion are high energy prices, the China rebalancing their FX reserves, and then quite an interesting one is certainly an escalation in the speed at which people move away from dirty energy into clean energy. So yes, short term, everyone's firing up every energy source they've got. Coal mines that have been mothballed across the world are being fired up to try and just make sure there's enough energy to get us through the next 12 months. So right now, ESG is out the window. But longer term, again, it's all about energy security. And if you can get anything that's cheaper longer term and happens to be green, well, that's certainly something that the country's going to look at. So nuclear is definitely back on the table because that can be done anywhere, and that's debatable whether that is green or not, but it certainly doesn't lead to global warming. The other one is hydrogen fuel cells, or hydrogen as a power source. Now, hydrogen is a great fuel source, but it is unfortunately very expensive. So right now, there's a lot of blue-gray hydrogen. So the way that is achieved is hydrogen is pulled out of natural gas. But we've got to the point where natural gas is so expensive that it's actually cheaper to produce hydrogen, green hydrogen, which is the cleanest fuel source, through electrolysis. You just take water, you separate the water into oxygen and hydrogen, and there's it's completely clean, and that is green and now cheaper than the dirtier version. So we are likely to see an acceleration into a lot of alternative fuel sources. Hydrogen is clean, green hydrogen is one of them, and then batteries is a big one. Not necessarily batteries that go into your cell phone or your electric vehicles, but one of the cheapest, or certainly currently the cheapest energy production is wind and solar, but it's very volatile, very dependent on what time of day it is, and what time of season it is, and storage of that power is something that actually makes those energy sources very, very expensive once you include the cost of that source. But there are all sorts of battery technologies that are being looked at. One of them is sodium-ion batteries. They're massive. You couldn't put them into your house or car, but if you have massive sodium-ion battery farms at your wind farm or at your solar plant, that is something that could work. So there's a lot of investment that's going into that. So on the 10th of May, we've got a webinar on our hard currency, our Irish funds. One of them is Fourth Industrial Revolution, and Eva is going to be talking about Fourth IR, but certainly there's a lot of fantastic, great new technologies that are coming through that are going to see a lot of investment as a result of the search for energy security. So 10th of May, keep an eye on that. Sorry, I forgot to mention, it was on an earlier slide. The other one is the 25th of May, and we're going to have a webinar on the skeleton absolute range. Sorry, that has been delayed. It was supposed to be last month, but on the 25th of May, there's the skeleton balanced absolute webinar. So just going to go back, just so you can see it there. So we have the Sygnia foreign currency webinar, that's 10th of May, and the skeleton balance absolute fund webinar, 25th of May. So just diarize those two and look out for them. They will be great webinars. So those are the longer term impacts of Russia. As we know, the shorter term impacts are already happening. There is definitely a peak in inflation. There's definitely a downgrade in growth, both of which are not great for earnings or equity markets, but a lot of that has been priced in. And we do certainly think that things over the next 6 to 12 months are looking better. Then back to South Africa, and I'm not choking this month, fortunately, but unfortunately, it's again a mixed bag. So we had great news after 2 years of continued state of disaster because of COVID. South Africa finally moved out of the state of disaster, and we could focus on just the growth path and reforms and getting things back on track. And Cyril had a great speech, and everyone was very bullish. And then we had the tragic floods in KZN and Eastern Cape, and over 400 lives are lost, massive damages. The estimates are very wide. It goes high as 17 billion rand, although I don't think they're going to be that high. But fortunately and unfortunately, what that's meant is that we're back in a state of disaster, at least for those regions. So here we have Dlamini Zuma saying the initial period will be of a state of disaster will be 3 months. And what's good about a state of disaster is it allows much more efficient and faster procurement, so you can get the services you need and you can get things rebuilt faster. But at the same time, it removes a lot of checks and balances that are needed to prevent corruption. And we saw what happened during COVID and the amount of corruption that was there. And unfortunately, the moment this initial 3-month period, and it may be even longer, was announced, there are a number of people who were rubbing their hands in absolute glee, because it meant that they could put through some exorbitant tenders and make some money out of misery. And that is terrible. It's absolutely terrible. And we've already seen a lot of the private sector food and relief assets that have gone into that region being stolen, being looted, and unfortunately, a state of disaster doesn't bode well for South Africa in terms of reforms or reduction in corruption. And talking about corruption, well, at the same time, this month, not only did we move back into a state of disaster, but we had Judge Raymond Zondo give out the fourth section of the state capture report. And here I was talking about the amount of looting or corruption that happened at Eskom. Total cost of nearly 15 billion rand of irregular tenders that were awarded that have benefited the Gupta-related entities over the last decade. 15 billion rand. Can you imagine if that 15 billion rand was put to building more power plants as opposed to just disappearing? I mean, we wouldn't have load shedding today. And instead, what we have, stage 4 load shedding happened in April, as you're all well aware. We had another record, Eskom, more Eskom records, unfortunately bad records were good ones. Record high of 53% of capacity offline, more than half of the power generating units were offline in the month of April. I mean, that's just terrible. For something that's been going on for 14 years, when we've brought on Kusile and Medupe, 2 new power plants. We've had 14 years to focus on trying to invest in repairing and bringing things back online, to look at alternative sources, and things haven't, forget turnaround, things are the worst they've ever been, 53% of capacity offline, and forecasting another 100 days of load shedding over the next year, and unlikely to get better in the next 2 years. So, as I've said before, we remain underweight South African equities. You need stable infrastructure, stable power to have growth. And unfortunately, that's nowhere to be seen. And there are more and more delays and things that are taking time. Yes, we had the 100 megawatts, or the reduction of the lifting of the 100 megawatt limit, but that hasn't actually helped, because other licenses are needed and connecting to the grid is needed, and there's been delays, and we're just not seeing anything happening. And we've got a number of mixed signals coming through from Eskom and from the government. So, as I said, we remain underweight South African equities. We remain overweight South African bonds. It has been a tough month. Over the last month, the rand weakened, but there's a large risk premium built into that. And when you're earning 6% in rand real terms, it's a great asset class. So we remain overweight South African bonds. And that brings us to the rand. You can see here the charts on the right of the last, well, year to date. You can see the red line, which is the rand strengthening very nicely, while other emerging markets weakened, until the last 2 weeks, when the rand suddenly blew out and weakened massively against other emerging markets. And it was basically a lot of own goals. So we had load shedding, we had a lot of, we had KZN floods, which is bad for growth. We had just a lot of own goals that were scored, and unfortunately, that overwhelmed the good news of higher commodity prices and the windfall that continues to happen. And that's another reason why we're happy to be overweight South African bonds. As long as commodities stay high, well, that's good for revenues, and it means that we can afford to pay the social grants that we need to pay, and we can afford to have a slippage on the expenditure side, because we have got a windfall coming through on the revenue collection side. It's not good for growth, and it doesn't mean that reforms are happening, but it does give us a bit more time to try and turn things around. And with an election year this year, there's going to be a lot more volatility, and we're unlikely to see any reforms happening in the short term, while promises need to be made. So, tough month for the rand due to own goals. We did take a lot of money offshore at 1450s, before the rand weakened so much. We increased our offshore allocation in our balance funds. Our benchmark is 28%. We took it up to 34% before the rand weakened. We have actually put on a little bit of protection at these levels, because we think it is overdone slightly in the short term, but the funds benefited from at least the ability to take us up to the 45% level. Now, as I said before, 45% doesn't actually work from a risk return perspective, because Regulation 28 limits your funds at 75% equities. That then limits your risk allocation or your risk budget. And while your risk budget is limited, you can't actually increase offshore by more than 35% because then your volatility increases. But you can tactically in the short term, and we have in the short term at least increased offshore to take advantage of that strong rand, 14.5. But we now think over 16 that you know, a lot of that risk is priced in, so we are bringing some of that back at current levels. So South Africa, again, mixed bag, overweight bonds, underweight equities. Positioning, I'm going to rush through the slide because we haven't changed much there. We only have a small overweight to global property as a bond proxy. We did buy a little bit more dollar bonds this month, but we're still very underweight global bonds. But dollar bonds, US bonds, maybe 3% on the 10-year, starting to look attractive, so we bought a bit of that, but still very underweight. So just closing some of our underweight. Still have no FANG, a little bit of 4R. That the outlook for those sectors looks volatile, but we're not selling 4R. We're just waiting for the inflation to pass through. Remain very overweight China and emerging Asia. Remain overweight, very overweight healthcare, and very overweight value. So, and those are all working very nicely to generate positive alpha in those portfolios. But a new slide which I put together just looks at our thematic funds and talks about the different ways you can access them and the fees that are associated. And I think this is quite nice there's a lot of different products out there, a lot of different funds, and it can get quite confusing. And I think this is a nice summary. So if you look at the 4 columns, you've got life policy, that's an endowment or a retirement annuity or a living annuity. That's in the gold color. So where that block is ticked, it means the product is available through that wrapper. Then we have unit trust. It's quite simple. Everyone understands unit trust. That's purple. So if this is ticked or shaded, it means that that fund is available in that color. ETFs listed, that's red. And then UCITS, that's the Irish domiciled foreign currency funds. Those are dollar priced foreign currency funds, and that's in the turquoise. So where that's filled in, those funds are also available there. So if you look at the top 2 lines, we've got the core funds, just spoke about last month. That's really, if you don't want to make any decisions, you just want to invest for the long term, and you want something that has everything for you, or the skeleton balanced range, you know, skeleton balanced absolute 40, 60, and 70. That's our core range. It has everything you could possibly need. It has tactical asset allocation. It's got risk budgeting. It's got allocation to all thematic satellites in the right proportions. It's all there at a very, very low fee of 35 basis points. That is the unit trust fee. It's also available on the life license, so RALA endowment, but it's also through a unit trust, 35 basis points. That's our core range. Or if you want global only, then our global 1200 ESG fund, that's global equities, it's developed markets and emerging markets. It's got ESG overlaid. It's got everything, again, at only available through the ETF, the red block there, but again, 35 basis points, all in TER, very low fees. It's a one-stop shop, a core, invest and forget. Then the rest are our thematic satellites, which are very much, if you're talking to your financial advisor, or you feel that you're confident in taking tilts to your fund, or overweights, underweights, then this is what you can look at to try and maximize your return for any given environment, or to align your portfolio with your risk appetites. Different people, different risk appetites. You might love the FANG stocks and want lots of Tesla, or you might think that China is the worst place to be and want to underweight China. Everyone has their own views, and these funds allow you to take those views and customize your portfolio around the core funds to exactly what you want to do. So emerging Asia, that's one of our big themes. As I mentioned before, the next billion in new middle class consumers is going to come through in Asia. New middle class consumers will have new spending. So in a world where we're seeing low growth over the next decade, you want to be invested in the areas that are seeing a growth in consumer spending, because that drives profits, that drives equity markets, and that's where you want to be. And certainly that's where everyone in the world wants to be. So you've seen all the global companies try and open up branches in India, in China, in Korea, to try and access these markets. So we have the Emerging Markets 50 ETF. That's the red block there. That's a 40 basis point ETF management fee plus VAT. Or that's your whole emerging market region. So that's mostly, it's 85% Asia, and that's Korea, China, India, but it's also got a little bit of South Africa, 3%, a little bit of Brazil. It doesn't have any Russia. There was a small allocation to Russia in that, but that's all been written down to zero, which hasn't been sold. But if you buy that, and at some point Russia starts to trade, well, these are UK listed Russian stocks, but if the UK Russian stocks can start to trade, or at least can see some fungibility with the Russian stocks, well, that's free upside. So but that's not why we buy it, but there is some free upside to a very small 0.8 in Russia in that fund. Then we've got two access to China. We've got the China New Economy Unit Trust in purple, and the China New Sector ETF in the ETF. That's available at 50 basis points. We think that the tailwinds to China are massive. All the Chinese industries are down more than half from their peak. There's a lot, I've spoken about it already, but there's a lot of, not only is a lot of emerging middle class coming through from China and policy support to drive that and that spend, but things are properly oversold because of COVID, properly oversold because of the tech regulations, and we are seeing that is all behind us. So definitely one of our favorite themes. Then the other big theme that we believe in long term over the next decade at least is aging populations. So fertility rates are falling, health care is improving, people are living longer, people are generally wealthier, LSMs are rising. That means not only are there more people getting older, but they have more money and they can then spend more on healthcare. So again, in a falling growth world, you've got to look for pockets of growth that can drive earnings, and aging populations are definitely a big one. So you want to invest in the healthcare sector. On the life side, we've got Oxford Sciences Enterprise. It used to be the old OSI, it's now OSE. So it's a Sygnia OSE fund, that's 1.8%. We've also got the Health Innovation Unit Trust. You can see the purple. We've also got the health, and that's slightly different because the Health Innovation Unit Trust has also got some exposure to the genomic and biotech sector, which is very exciting. A lot of innovative stuff happening there. That has seen the same headwinds that Fortha R and FANG have seen. So a lot of risk being priced in, and we think that we've got about 30% of those stocks are trading below their cash value. So free options on that sector, and we're quite excited about that. So that's in the unit trust. Then we've got the healthcare ETF, that's in red, 50 basis point TER. So that's your standard market cap weighted top 150 global developed market healthcare. It's doing incredibly well, very defensive, still benefiting from all the byproducts of all the R&D that was spent on COVID. So yes, COVID sales are certainly rolling over, and a lot of those COVID sales were done for free anyway while we were in the pandemic. But there's so much other R&D that's positive benefits that are feeding through that this earnings and product continues to just price upside. And then we have the first one that I'm talking about, but the healthcare innovation UCITS fund. So this is the same as the unit trust. It's got the top 150 plus the innovation overlay, and that's available in hard currencies in dollar terms. So if you have got dollars that are sitting offshore doing nothing, or it's sitting in a very expensive active fund, you can move it into our health innovation UCITS fund, low fees, getting access to this great long-term theme of aging populations with some genomics and biotech exposure as well. And yeah, it's a great defensive sector. Then disruptive technology. Fourth industrial revolution, we all know, is a wonderful long-term place to be. It has struggled with rising interest rates, and it generally just got overdone with the COVID period, where there was so much focus on moving away from the old world to the new world and Zoom and online businesses, that it got a bit frothy. And we sold out of our fourth IR in February last year. We bought back in towards the end of last year, which is a little bit early, but we only have a small exposure there. Has faced some headwinds. We do think it's a great long-term product. Today might not be the best place to buy. We're not selling, certainly not. But we're getting closer and closer to the bottom with core inflation already rolling over in the US. But it's certainly we think too late to sell, and you want to start to nibble at that, or maybe wait for a better entry point. But Eva's going to talk about more about that at the webinar on the 10th of May. Some fantastic businesses that are benefiting as we move into green energy, as we move into new healthcare technology. Basically, any new market segment that is there. Fourth Industrial Revolution Fund targets that. We have that available in the unit trust. We have it available in the ETF locally, 50 basis points, and we have it in the hard currency Irish dollar priced fund. So if you want exposure, if you've got money offshore, you can exposure to our disruptive technology fund and we also have the FANG fund, FANG Plus Global Equity Fund, which is only available in the unit trust at 70 basis points. And there are two fee classes, A and B. That's been hurt really hard, and things are certainly looking a lot cheaper. But we haven't started nibbling at that just yet. There's still a lot of valuations are looking quite stretched, but it is still the businesses within that are perfect disruptors. That it is the new technology. It's moving towards online platform companies that are stealing business from brick and mortar. Yes, there is going to be some volatility as we roll out of the COVID period. And yes, Netflix has got some headwinds, and Facebook's got some headwinds, and there are regulatory headwinds. But disruptive technology as a theme is not going anywhere. And we certainly believe that some of those business models are fantastic. Fantastic moats. Apple has got brilliant moat built around it. Amazon has got a great moat built around it, and those are solid businesses. Then our value theme, and here we have the Berkshire Hathaway Fund, which is, as I said, is the top performing fund over the last year. Global value continues to do very nicely as we continue to move into a rising inflation environment. 40 basis point fee for that fund. I think things may have gone. I think a lot of the good news is priced in terms of this. We haven't started to sell value at any point, but again, we aren't buying any more value at this point. Things have done very nicely. We don't think the tailwinds are going away anytime soon, but a lot of the upside is priced in. Similarly, we've got the Divi Fund on local equity value to the unit trust. That's at 0 fee. So that has gone through. If you buy the Class B, 0 management fee, you pay nothing. You only pay if the fund beats the broad SWIX index. So if value as a style outperforms broad index, the SWIX index, or then you pay some performance fees, otherwise you pay nothing. So a cheap option on value. And that's, as I said earlier on, that continues to do very nicely. Global income, we've got two funds there. We've got global property at 18 basis points. So if you are looking, as I said before, if you have your retirement annuity and you maxed out on global equities at equities at 75%, and you're looking for some exposure, then you can get the global property ETF at a steal 18 basis points. Or you look at the Skeleton Global Cash Fund, which our note went out to last month. That's at 65 basis points. Or the UCITS fund, Global Income UCITS Fund. So that target, both funds, they target dollar cash as a benchmark, but they target to outperform that slightly by sort of just being invested overnight cash and slightly longer dated income assets, similar to the Enhanced Income Fund locally. So 1 to 2 year index, there's not much duration risk. They are getting a bit of credit to help the yield, and there the credit's all green bonds. So it's very high quality assets in that fund. And then locally, if you're looking for South African income, we've got the Income Maximizer at 50 basis points. That's a perfect blend between Enhanced Income, which is the one below, which is a pure low risk credit fund. So Enhanced Income has no bonds, or very little, 1% bonds, 1% property. It's 98% credit. And then Income Maximizer blends that with some bonds to get a bit more better, higher yield. So it's a bit more volatile, slightly longer time frame. But those are our two South African income funds. income maximizer only available through RAs, LAs, and endowments, and enhanced income through unit trust. So that's a nice summary of all of our portfolios. And sorry, I see we're nearly running out of time. And then the different wrappers are invested and then the different fees. So let's bounce over to some Q&A. Thank you everybody for questions that you have sent through. Book says a very tough question. Would you sell 4,000R to buy Sygnia China? So what we've been doing lately, I suppose it doesn't really answer the question, but we've been topping up on China and we've been topping up on Fourth Industrial Revolution. So I think at the moment, even though I think there's a much stronger likelihood of a shorter term bounce in China because all the catalysts are there. You've got policy support, you've got earnings support, you've got COVID rolling over, you've got change in the regulation focus on the platform companies. 4,000R is looking a lot cheaper, but you're going to have to wait for inflation to roll over. And while core inflation has already rolled over, I think it might be a couple of months before we start to see some positive catalysts on that. So I wouldn't like to choose between the two. I'd buy both, but I think that there's more short-term upside in China. Bradley asked about our attempts to launch a crypto fund. Well, our view hasn't changed. It's still mixed. Depends who you ask. I'm still not a big crypto fan, but there are certainly a lot of my team, the investment team, are very excited about crypto. So we do have a working group that's trying very hard to launch an ETF. We were about to launch a blockchain ETF, distributed ledger ETF, which focuses on all the blockchain technologies, and as a result has quite a strong exposure to crypto businesses and crypto itself. But we've unfortunately hit some snags with the FSCA and the South Africa Reserve Bank, who are concerned that it is too risky. So we are busy debating that, and that unfortunately there are some regulatory hurdles locally. Even though we are tracking an index, it's a global index, and it should be in line with what we're allowed to do. It certainly has its risks. So that has been delayed. It hasn't gone away, but it has been delayed. So it's on our radar. We are trying, but it's not an easy process to be done. Dave asked, do we sit tight in the FANG fund? Certainly. If you've got a long-term time horizon, which you should because you're invested in equities, the FANG fund is a lot of the froth has come out, and we've got 10% of the FANG funds in 4,000R, which is fantastic. It's well diversified across a number of companies. 23% of the FANG fund is invested in China, Alibaba and Baidu. 10% is invested in Europe, so it's not all about the US. We have tried to diversify that as much as possible, and although again there's a lot of volatility over the next 6 months, I can't see a strong catalyst for the bounce in the next 6 months. Over the next 5 years, you know, those businesses are here to stay, and they've got strong moats and they're not going anywhere. Andre asked about Sygnia's view on SA listed property. So that's one I can outrightly say that we're not very positive on. I've removed it from our strategic asset allocation. We've replaced it with global equities. There's a number of reasons. First of all, it's just tiny. It makes up less than 3% of South African listed equities, and South African listed equities are tiny in the global world. There's also just a lot of headwinds, and while it's looking cheap in terms of the yield, that yield's not going to grow in real terms. So really, for the next 5 years, you've got to look at South African property as an alternative to a nominal asset class like South African bonds, where yields don't grow. And you've got South African bond yields sitting at 10, 11% yields. So property, you know, sitting on an 8% yield is not looking as attractive. So right now we don't have, we've reduced our exposure to that South African listed property. It's not to say we won't buy tactically in the future, but there structurally are a lot of headwinds. Before we even hit COVID, there was a demand-supply imbalance with too many shopping malls, too much exposure in the industrial area. With what we really need is a SA growth boom. And now, even with interest rates rising, what's a further headwind to South African properties? Most South African listed property is 40 to 50% geared. and that the higher debt costs fall straight through to the bottom line, which is not great. So yeah, staying away from that sector ourselves. Little bit, tiny exposure in our income funds was sort of a diversified yield, but not much. So Sygnia Itrix MSCI EM50 ETF. What is the fund's view? So as I said, on the Russian side, the fund had about 3% exposure, but that has now been written down to 0, and that's been those assets have been frozen. So if there is any value in that, those haven't been sold, and when they start trading again, that will come back. But right now, there's effectively 0 Russian exposure, so there's no Russian risk. There's only upside if there is some upside to those companies. So John asked about my comments on resources. So it was a bit confusing. Resources are cheap. That's on a PE basis. Generally, when they're cheap, it's not a great time to buy them because they're very cyclical. And by the time they are cheap, the commodity prices are already rolling over. And we have seen a rollover in a number of the commodity prices that have happened. But the commodity prices are going to remain more elevated than they have in the past in other cycles because of the search for strategic energy. And that means that although they're cheap, it doesn't mean that earnings are going to fall off a cliff. That's generally why they do trade cheaply in the past, and why prices haven't, or earnings have what normally happens is they're cheap and they become expensive, not through the prices going up, but through earnings falling. Right now, we're probably going to see earnings not falling as fast, and so prices might continue to rise. And so resources are not necessarily as cyclical as they have been in the past. I suppose that's the bottom line. So again, we are looking at launching a resource ETF. We haven't made the decision yet. We are meeting next week to discuss it because of the fact that the cycle is going to be longer than previous cycles. And there's more to it in terms of not only energy security, but ESG driving, prolonged lithium prices and prolonged energy specific commodities. So copper is very big on EVs, uranium as people move more towards nuclear. So we may have a non-traditional resource ETF that we're going to be launching, but again, we're talking about it. Haven't done anything yet. But at the moment, if you like resource exposure, then buy the Divi fund. Great dividend yields, strong resource exposure in that. Generally, though, South African stock markets have big exposure to resources, much higher than any other market out there, besides probably Australia. So, we are really well diversified, and we do have quite a lot of resource exposure in the SWIX and the CAPI and the Aussie. Books are also in our new investment platform. We will be operational. I saw a teaser go out that it's coming soon. That's all I can promise, is that it's coming soon. I can't give you a closer date than that, but it's we should have something soon about how soon that soon will be. So watch this space. Jeannie asked about performance fees. So a couple of our funds do have performance fees. There's always a flat fee option. So if you look at some of our funds, where there are performance fees in the A class. If you don't want to pay performance fees, you can look at the B class, higher base fee but no performance fees. And they tend to be in the unit trust space, so that they work on very much the CISA performance fee standard. So CISA and FSC have very, very strong rules and regulations about how you can do performance fees, and we have to follow those guidelines. So the way the performance fees works is very much driven by CISA and FSCA guidelines. The Sygnia New Economy Global Equity Fund and the Sygnia Itrix China New Sector Fund, mouthfuls, are they invested in the same stocks, or how are they different? That's a great question from Mervyn. Thank you, Mervyn. So they are very similar. So they are slightly different in that the S&P Sygnia Itrix China New Sector follows the S&P index, and they've picked sectors where they think that are new economy sectors. For the unit trust, we pick our own sectors, and we use a slightly different data source. So we not only have we gone down to the 4th level of industry classifications, we've gone down to the 6th level. So we're a bit more granular in terms of how we pick sectors, and so it can be a bit more nuanced, but they are quite similar. The concept is very similar, although there will be slightly different holdings, and they are very similar funds. John asked a tough question. So the Berkshire Hathaway, I said, is fully priced because it has done so well relative to S&P 500. And he says, well, what should we use to access the USA? So in our balance fund, so in every Sygnia fund where there's global equity exposure, whether it's Skeleton Balance 70 fund or the Skeleton International Equity Fund of Funds, we have got access to the S&P 500 value ETF, which is probably the best exposure. Second to that, we've got Berkshire Hathaway, and that's also done very well, which is a value proxy. And then the third option would be just buying S&P 500 or US 500, which has got quite a strong growth outlook. So yeah, right now I would still say it's best to keep exposure to value. So we're not selling our Berkshire Hathaway, but it has done very well. But it's still over a 3-year period underperformed S&P 500 in terms of more values and styles underperformed. So I think there's a bit more upside. So tough question. Right now we've got our exposure through that value ETF. Kubas asked how much the Sygnia core funds, Skeleton at 70, for example, has to thematic themes. Roughly about 30%. So 30% of global equity is in the satellites, and about 70 is in the core. So it does vary slightly per fund based on risk appetites, but that's your rough blend. And I said you can always top up that thematic exposure if you want to by holding Skeleton Balance 70 and then some of those themes. EP asks about the offshore funds versus the onshore funds. So again, dial in for the webinar on the 10th of May about our 3 UCITS dollar-based Irish domiciled funds. We have the Fourth Industrial Revolution Fund, we've got the Health Innovation Fund, and the Global Cash Fund, Global Income Fund. We are also looking to launch China and a new fund for our 2.0. So, but looking at those funds, they all are as close as possible mapped on the local unit trust version, so that you should get almost identical exposure, except that one will be in dollars and one will be in rand. So if you remove the exchange rate from it, they should be very similar. So whether you are invested in the Fourth Industrial Revolution Unit Trust or the Fourth Industrial Revolution UCITS Fund, should get similar exposure when you control for the currency. So likewise, if you're in the Health Innovation Unit Trust or the UCITS Health Innovation UCITS Fund, same exposure. And when China is launched, same process. It'll follow the same benchmark as the unit trust and should give similar performance once you control for the currency. But obviously, one's in dollars, one's in rands, so there will be a currency differential. Nick asked if the Berkshire Hathaway fund is open. It is open. It was only closed because of the living annuity limits for some that Sygnia had. The retirement annuity was always open, so that you continue to buy Berkshire Hathaway in your retirement fund, and the living annuity limits are 35%. So if you're not at 35% level, you can also buy Berkshire Hathaway through that route. And as I mentioned before, we have also opened up OSI for a limited period. I don't think that capacity has run out yet. So if you are looking to OSE, if you are looking to get some OSE exposure to diversify your healthcare exposure, that's also open at the moment. David says, pity we did not see your cat in a while. Thanks, David. I'll make sure to do a webinar from home at some point to make sure that the cat is there. He'll be very happy to hear he's missed. Mona asked what key indicators we should look at to signal the end of the commodity run. That is a great question. So the commodity run has really rolled over, and the reason for that is China. So China is the biggest user of commodities. China uses more than half of the commodity supply in the world. I mean, it's really massive. So the moment China tried to start to cool their property sector, commodity demand started to roll over and started to soften. And you know, I was quite negative on resources, if you remember, as a result. What kept resources somewhat elevated was the ESG demand. You know, a lot of excess demand for copper because of electric vehicles, and there was some shortage of supply in various things because of COVID. And so you had a slowing China versus ESG demand that was not above normal, and you had COVID supply disruptions. And so commodities kind of, although they rolled over, they kind of didn't fall too much. And now, even though we expected commodities to continue to fall, now we've got the further supply disruptions of Russia, which again is probably going to last another year or two. But at the same time, we've got China softening. China's property sector is going to continue to soften. It hasn't reached the bottom, but again, you know, there's so many moving parts in this equilibrium model. We've also got a lot of Chinese stimulus. So you know, we've got slowing Chinese property market, which is what caused the property commodity cycle to roll over. A lot of Chinese stimulus. So we might actually see some demand from China stabilizing, which will help commodities. So before we even see the rolling over of the energy crisis driven by Russia, we might see demand picking up from China. So all in all, because of all the supply disruptions, we actually are able to look through some of the Chinese weakness. Chinese weakness is still the overriding factor, and that's why commodity prices have rolled over. But all the supply disruptions are why commodity prices haven't fallen as hard as they should have or have in the past, and should keep things relatively muddled until we see some strength come through from China. So it's not a great picture. All I'm saying is it's going to be very volatile, and it's not going to be as bad as it was in the past. So you know, I was quite bearish on resources in the past. I'm not as bearish as I was because of the supply disruptions that are coming through on the energy side. So it is a great hedge for inflation, and it is why South African equities have been the best performing of emerging markets over year to date, and in fact some of the developed market world, South African equities have done very well. Until the Rand weakened, we were one of the best stock markets around the world because of resources. So we already have a lot of resource exposure. So it's a big debate about whether you should add more resources or not, and there's a lot of moving factors, and commodities are very cyclical and you know, driven by supply and demand, and you can't predict COVID supply disruptions. You can't predict you know, Russian supply disruptions. It was hard to predict the Chinese property sector slowing, because a lot of that was also regulatory driven. So resources are hard to predict. The bottom line, their cycles are very volatile, and so I'm not going to tell you that I'm calling the bottom of the cycle by any means. I'm not predicting that. I'm just saying that supply disruptions are going to keep prices elevated for longer than we thought originally, which means that resources are going to be supported for longer than we thought, which is good for the Rand, good for emerging markets. And if we didn't have so many own goals right now in South Africa, we would be doing better relative to EM than we are. And that is a wrap of all the questions. And I see we are well past our time. So thank you so much to everybody for tuning in. I hope it's been helpful. Good luck for the month of May. As I mentioned in our note, month of May is when you need to sell and go away. But that is not necessarily the case this time. It is certainly not an investment case, although it is cyclical. Staying invested from May to November in the past, although it hasn't beaten the 6 months of summer, it has beaten cash. And given the fact that we've had such a strong sell-off the last few months, given that investor sentiment is so negative at the moment, we definitely think that sell in May is the wrong call this month. And as I said, we've gone neutral, and we may even go overweight risk in equities if things carry on the way they are carrying on, with inflation rolling over in the US, and things not getting progressively worse in Russia and Ukraine. So if all of that is priced in, then there could be some decent upside over the next 6 to 12 months. So hopefully a better May than historically, a better May than April. So here's to being bullish, and have a great May. Cheers, everybody.